And we are recording. This is Multifamily Masters live from multifamilymasters.com. We do this every 2 weeks. Our goal is to provide as much content as possible free of charge. We bring on awesome guest speakers. Tonight we have a fabulous panel of 3 individuals with a ton of experience. I will let them introduce themselves here in a few minutes. We are multifamilymasters.com. What are we? We are in the process of creating the world's largest platform for multifamily real estate, for cash flowing real estate, for multifamily meetups. If you're interested in hosting a meetup, we have approximately 70 meetups across the globe, international. The furthest one we have is Hong Kong. And we originated right here in the good old US, and that's the majority of them. COVID threw a little bit of a wrench into that. We came up with this online platform. It's worked out really well. Every 2 weeks we do this. Me and my 2 business partners, I'm very fortunate where I have the best business partners in the world, Mr. Feras Moussa, Mr. Pal Chi. Together we have a combined 3,000 apartments or so that we own and control and have approximately 30 years of experience. We want to help you learn, share, network, and grow this business as best as we can. We have a mastermind program. If you are looking to have someone hold you accountable, if you're looking for someone to look over your shoulder who has been there, done that, does it every day, all day, awesome. We want to help you. Reach out to one of us, any of our support staff. Check on our website, multifamilymasters.com. Tell us you want info on the mastermind. Awesome. On top of that, this recording will be available. Let me hit the admit all. This recording will be available in our YouTube channel tomorrow, multifamilymasters.com. If you're not a member of our Facebook group, get on Facebook, hit the little search on the top, type in multifamilymasters.com, search for our Facebook group, hit enter. That's pretty much all I have. Mr. Powell, Mr. Feras, my name is Garrison. A little bit about me, 20 years of experience. I'm from Baltimore, Maryland. Just trying to learn this business, trying to grow my portfolio. Right now I'm into about 600 apartments. I would like to get to 10,000 apartments. And I come here tonight to learn from this expert panel and see how I can grow my inventory to get on their level. Feras and Powell, feel free to take it away.
Awesome. Great intro there, Garrison. Hey, everybody. How you doing? My name is Powell Chi. Live in Los Angeles. I'm a real estate entrepreneur, real estate investor. All of my investments have been out of state. So I started this group about 3 years ago, and really it was because I was going to a lot of meetups, but I wasn't meeting the same people that I wasn't meeting the same people that had the same interest that I had, which was really investing in multifamily, but then also investing out of state of California. And so formed this group about 3 years ago with about 8 people. And out of that, it certainly just started blowing up and got a lot of interest, got regional interest at first in Southern California, then started to blow up into the United States and now globally. So super excited about running this and having this and the business partners we have and the speakers that we're able to bring on basically every couple of weeks and where we think we're going right now with Multifamily Masters. So a little about me investing wise. I started investing in multifamily about 2017, right at the very beginning of 2017. There was a small 40-unit building that I got by myself. It's in Indianapolis. And from there, it took me about a year later to get my next property, which was a joint venture with about 61 people. I mean, 61 units and then 6 people in it. And that was also in Indianapolis. And that was in 2018. And soon after that, 2019, was able to jump into syndications, jumped into about 5 syndications on the general partnership side. So a little over 1,000 units total. And also like right now, I just got under a contract for another deal. So super happy about that as well. So, okay, that's cool. Feras?
All right, so hello everyone. For those of you that don't know me, my name is Feras Moussa. I have a company called Disrupt Equity. We primarily buy assets throughout Texas and Georgia. Currently, we have about 1,500 units that we own and operate. We've sold a few. In addition to that, we are vertically integrated. We have a company called Disrupt Management. We do manage properties kind of throughout Texas and soon Atlanta as well. So that business is continuing to grow. And, you know, for me, my background is software. So I used to work at Microsoft, kind of left that, had a tech company, and really spent the past several years really figuring out how do we apply more tech into real estate? How do we rethink all the norms and kind of disrupt it, so to speak? But that's enough about me. You know, today, for those of you that don't know, right, we're doing a construction panel, so definitely excited about this one. And, you know, I think a lot of people on this call usually come from kind of a traditional syndication model, right? Buying CB value add properties, money's going into them, you know, raising money based on that, with obviously the goal of getting distributions, implementing a business plan, doing distributions, or making an exit. And construction is kind of the scary thing to most people on here. So we figured, you know, back to Garrison's point about how do we continue to educate people? How do people continue to educate themselves? Well, construction is, you know, I've been something I'm not an expert in, but learning a lot more in. So I was personally looking forward to having this one. But it's, you know, something that I think doesn't get enough attention because everyone thinks it's the big institutional companies that only know how to do that, right? Where I think, you know, this call, people will learn that it's really not just that, just like apartments, right? You know, it's a group of people doing things together kind of with a common goal. And so with that said, we figured, you know, who not better than having John, Michael, and Darin come on board. And so maybe I'll let each of you introduce yourself. I know Michael and John are, what's the word I'm looking for? Recurring guests of the show. So excited to have them participate. But Darin is a newcomer, but Darin comes with a wealth of information. So very excited to have him participate. So thank you all three for participating. And before we kind of kick it off, right, for those of you looking for the first time, right, we'll kind of host it. It's going to be very casual. So we'll do about another 30, 45 minutes of just open Q&A. I have questions and people are welcome to ask questions as well. So if you have questions, go ahead and leave them in the chat and I'll go ahead and ask them to the audience. And then, you know, after that, right, once we get kind of closer to about 8:20 Central, we will basically, you know, kind of wrap up and break out the audience into breakout rooms, right? That's something we've been doing the past several shows. It's gone very well. And really the idea is to break it out into smaller groups of about, you know, 7, 8 people, where you can get to know one-on-one with some of these people, hopefully some of the guests, right? Real estate is absolutely a relations business. And so something where, you know, a big goal of multifamily masters in general is to help network people, help connect people. How do you connect with that guy with the glasses over in Maryland? How do you connect with that guy over that lives in LA that thinks he's in San Francisco, right? So, you know, getting to know these people and kind of networking with them, and that turns into opportunity and relationships and hopefully, you know, growth together. So with that said, that was long-winded. I totally just kind of thought of all that on the spot, but let's go ahead and introduce our guest. So John, I want you to go first. Do you mind just kind of giving everyone a quick, just 1 minute background about who you are and what you know, who you are, where you're located, and what you're currently doing on the new construction side? And I know that what you're currently doing can be long, but just very high level, and then we'll start to dig into it. Questions.
Yeah, before I do, I want to know where Powell got his tan.
It was a bottle, orange bottle.
That's what happens when you play beach volleyball and you sit on the sun too long. So you get that sun just hits you. Doesn't.
So for those that don't know,
Powell plays
volleyball, I think almost every Saturday, right, Powell?
Saturday and Sunday.
We have a Saturday morning call, and after that, he gets tired of talking to me and Garrison, and then he goes off and plays.
See ya. Time to go play volleyball.
Anyway, I'm jealous. My name's John Monteiro. Thank you, Garrison, Powell, and Feras, and the rest of the team to have me on. Excited to be here. I'm based here in Frisco, Texas, which is a northern suburb of DFW. Moved here in 2009 in the depths of the last recession. So here we are again. We actually moved here for exactly this type of opportunity in real estate. We took a bet on, we being my family and I, took a bet on Texas and on DFW to take advantage of what we thought was going to be a big run up in population and job growth. We've definitely seen that over the last 11 years that we've moved here. We're going to continue to see it moving forward. I've been in the multifamily space for about 6 years now, 3,100 doors with other partners and investors. About 2 years ago, I started to kind of see that cap rate continue to compress between the different classes, and the cost to build versus the cost to buy continue to narrow. So at that point, I pivoted and still do value add multifamily in Texas, but also now have pivoted into the new construction space where we've got a couple of projects working, 2 of them in the DFW area and 1 down in the Houston area.
Awesome. Thank you very much, John. Always a wealth of knowledge. And Mr. Michael, so Michael's over here in our backyard, so doesn't come out to our office enough, but Michael, you want to go ahead and introduce yourself as well?
Yeah, sure. Hey, everyone, and thanks again for the invite. Michael Lee, I'm out of Houston, as Feras mentioned. We are local buddies here, and a group here in Houston. My background's in IT. For about 12, 13 years, I had a consulting company here, and then about 6 years ago, started making the pivot into real estate. Started out, like most people, into the single family side. Quickly decided it wasn't quite for me, and then jumped onto the commercial side. So to date, in partnership from both the GP and the LP investment side, in about 4,500 units, I still asset manage 5 properties right now. And similar to, as John said, just seeing the compression between the different asset classes and seeing that there's opportunities available on the construction side. And the deal that John mentioned down in Houston is a deal that me and him are in partners on. And so we'll be talking about that a little bit more. But it's a fun space, and definitely eager to share with you guys what we've learned. So.
All right. Thank you, Michael. And last but not least, Darin, you want to go ahead and kind of introduce yourself?
Thank you,
again,
sir.
if you guys haven't noticed, all our speakers are based in Texas. I'm just going to leave it at that.
Hey, thank you guys very much for having me on. Started out in real estate, and I'll differentiate the two here shortly. But in 2001, was living out in California, had a couple of life events that happened. We had the .com crash, and I said, you know what, it's time to go back home and go back to Texas. And there was a few events that happened, and what it did is it put me over into the real estate space. And then from there, we started learning the upside and value of commercial real estate. So in 2010, we did our first ground up development. And if I can tell you guys anything, I had never done one before, didn't know what I was doing, made every mistake I could have possibly made. And I will share a few of those with you guys tonight. But here we fast forward 10 years later, we still have that asset. That's one of our best performing assets today. So I can't say enough good things about the development space. There is opportunities there. Talking about what happened in 2008, 9, and 10, and we're kind of seeing some of the same things happening here. I still think there's a lot of great opportunity, and I look forward to sharing that through the Q&A and what we've experienced and what you should do, in my opinion, and things you should absolutely avoid.
Awesome. Thank you, Darin. And question, Darin, maybe to kick it off, Darin, have you done, I don't want to call it traditional syndication, have you done value add syndication before, or only kind of new construction?
Yeah, very good question. And there was no really method to the madness, but we did not do value add construction. We kind of went into this not knowing what we were doing. And if you can imagine in 2009, when we were searching for debt, nobody was lending, okay? I had a term sheet from a very large institution to do our first multifamily deal. And they just called up and said, sorry, we're withdrawing the term sheet. I said, well, you can't withdraw the term sheet. We have a deal. Said, okay, sue us. And I said, okay, what do we do? And at the time, and they didn't really say that, but that's kind of the attitude that we got. But at the time, a good friend of mine said, hey, have you ever looked into HUD? And I said, I don't even know what you're talking about. And HUD has a development program that has pretty good leverage. And if many of you guys, we'll maybe talk about this a little bit later, but that leverage component can be 80-20 on a new construction project. Well, back then in 2010, when we were trying to get our loan closed, 2009-10, HUD was the only person lending. So we packaged up our asset, packaged up the details, actually hired a developer, hired a general contractor that was, and both of these guys were more HUD qualified. And we put it in front of HUD, and we actually received our loan, did the asset, made a few mistakes, like I said, and I'll share some of those with you, but that put us into the ground up development. And that's just kind of what we started doing. So there was no, conscious decision. It's just that was our roots, and we felt good about it. We knew we could do it again and again.
Awesome. And so maybe on that note, I mean, to me, it's almost crazy to think, construction was kind of the first thing, right? And so, I mean, maybe my question, I don't even know how to ask it, but really, why did you think that was a smart decision at the time versus, something to me that's a little easier, right? Which is something that already exists.
Well, think about it. Let's go back to the debt answer, okay? we couldn't get debt. There was nobody lending, and we had no choice. We had almost $1 million tied up into the asset, into the property of raw dirt, architectural plans, engineering plans, consultants, attorneys, and. And I think we just looked at it and said, we have to figure this out. Now, is it the greatest example I'll share with you tonight? Absolutely not. But did we learn a lot on that? And we didn't really have a choice at the time. I mean, there wasn't, some of you guys aren't even old enough to, I think you were still doing IT 11 years ago, okay? I mean, people were not, even the equity side of the deal. I mean, it was tough to raise equity, just common equity. So we were like raising common equity from our friends and family, trying to secure a debt loan when HUD was just about the only person lending back then. All the banks were frozen. Everybody had stopped.
No, I totally agree. But I guess my question was, what led you even get to the point where you already had $1 million wrapped up in it, right? That's maybe, I'm talking about even.
Okay, let's take that one out. Yeah. What we've decided to do is, and somebody mentioned, I think it was John mentioned cap rates. And I think that's a great example. If you look today at buying an asset in the DFW area, you guys are paying, I think, on an acquisition of a nice B product, you're probably paying a 5 cap. I would think. We don't really look at the B space that much, but what we see come across our desk, we see a lot of 4.75s, 4.5, 5.1, 5.2, depending on a primary, tertiary market, and kind of if it's in Frisco versus somebody way far west of Weatherford or something like that. But we started looking at that, and we just decided that, if we can build it at if we can build it at a 6.5, sell it at a 5 on the yield, and if we're competing against a 4.5 to a 5 cap rate, we'd rather get a great location. We'd rather build a Class A asset, institutional quality, and something we can hold on for the next 5 to 10 years, should we want to. We're a little more longer term. We never did get into the BC space and really do the rehabs and the flips. That wasn't us. And again, that's just coming back to where our first deal was.
Yeah, you got to keep your hair, man. You didn't have to do the CV value add. Trust me. It's
I know. I mean, you guys, I
very different kind of play.
You guys do the BCs. I'm amazed at how well y'all have done. I mean, it's fantastic what you guys have done. The guys that work in that.
But a lot of what you said resonates a lot to me personally right now, and just in terms of, we've been looking at a lot more A and B plus assets. I mean, the C value add, the cap rates are getting just so tight, and you're buying. Really, some of these deals are trading at 4.5 caps, right? On the assumption that you can do the value add to get it to a 6, right? And it's
a lot of assumptions.
It's exhausting, so I'll leave it at that. Okay, so really, I think the answer to my question is just that returns-wise, right? It just didn't make sense to you, right? So you kind of pivoted more.
And we just had a longer. Our investors were more long-term, and we looked at cap rates, we looked at control, and to us, development is not risky. Okay, it's just. We have a great development team. We have a great general contractor team. The general contractor, we have ample reserves. General contractor's got what's a GMAX contract. The contract is bonded. We just have a lot of safety nets and insurance policies in the whole process that allows us to feel really comfortable going through that process. And if you get a good development partner and a good GC, they get it done. I would never, ever encourage anybody to try to go off and do development construction on their own the first time, unless it's, something real small and simple. But small and simple is a 4-plex, okay? And that's not what we're talking about here. There are some really good development teams and GC teams all over Texas. And that's where we pretty much stay in the Texas market.
And actually, sorry, and one quick question, then I'll move on. Just so people know, what size units or properties are you talking about?
So most of our properties, and we kind of work off anything 200 units or north, and I'd say 40 million to 55 million debt and equity through the whole thing. So we have 2 projects right now that are north of 300, but most of them are in that not low 2s, more in the 240 to 280 range.
That's perfect. Thank you very much. So maybe let's move on. So Michael, I want to ask you, and John, both of you, kind of a different question, right? Which is, obviously both of you came out of kind of the value add space, right, so to speak. What led you to kind of want to go into construction? And I mean, how's it been, right, so far? Or is it too early to know, right? So for both of you, that's kind of the question I want to ask. So Michael, you want to go first?
Yeah, sure. I mean, a lot of what's already kind of been discussed, but, you know, as Darin mentioned, you're looking at a B product, you know, 80s, 90s plus build, especially in the, you know, you mentioned Frisco, hot area like that. I mean, a lot of times now, you know, you're probably looking at, you know, roughly 150, 160 plus a door even for these units. And so it got to the point where you're beginning to realize on a price per square foot level that you're paying you know, at the same as what you could build for, and it's a 40-50-year-old product versus something that's going to be brand new. So once you start doing that math and putting two to two together, it's like it just makes sense to at the very least explore that. So we started exploring it more and more and seeing that it was still very viable option for us. And it, you know, it wasn't, as you mentioned at the beginning, it wasn't as scary as maybe we had thought initially, right?
Mm-hmm. Got it. And then so far, right? I know you're earlier in the journey. How's it kind of going? Is it as expected, better than expected, harder than expected?
I think it's better than expected. I think it's you know, just what we find out is finding the right partners. As Darin said, you don't want to come in here just trying to do it by yourself. Bringing in the right teams. You know, we've got a good team. Architects or civil engineers. We have a you know, construction management consultant that's helping us out, making sure that we're doing some value engineering. We're making the product look a good A-class product, but at the right pricing, right, to keep things in order. You know, so you just having the right team on board will help guide you in the right way, right?
Yeah. Cool. Well then, John, I want to ask you the same questions, and I'm going to yin-yang back. I'm going to ask you another question, John, then go back to Michael, because I'm in my head, I'm building up kind of the pathway for the questions, so it all ties together. So,
sure. I mean, if you look at you know, like a C-class cap rate, you know, call it 6 to 8 years ago. I mean, you can get a C-class for a 9 to 10 cap back then. Now the C-class in DFW is probably a 5.5, which is crazy, right? And to Darin's point, I mean, you could basically build something for pretty much that cap rate or even better. And so that was really what caused the pivot for me a couple of years ago. You know, I took a lot of time and a lot of research before I jumped in. Just like in the value add space, you got to build the right team around you, like Michael mentioned. And so that's what I did. And with regards to Darin's point around risk, I am extremely low risk tolerant in anything that I do, probably because of my age. I just can't afford to make bad mistakes. Yeah, you too, Darin. And so, you know, I always kind of think about how do I de-risk every deal that I get involved in. And I know that isn't really answering your question directly, Feras, but I think it's an important point where, you know, I basically look at 4 very important risk points in new development. And if I can't check the box on all 4 of those risk points, I'm not doing the deal. And I'll just quickly run through those. The first one is entitlement risk. And I think that's the biggest risk in new development, to be honest with you, is kind of getting your project, getting your land through entitlements. The second one is once you're at entitlements, what does that capital stack risk look like? Darin mentioned that in his debt conversation earlier. The third one is execution risk. And that's really, you know, making sure you're executing the project as planned. And finally, if you're going to exit, what does that exit risk look like? Because you're going to be delivering product 3 years from now. And what's that market going to look like? You know, none of us know, but you gotta take a bet on those 4 items. And so if you're able to really kind of de-risk the deal, really understand your numbers, build your team around you, and just heads down execute, for us, it's a good opportunity.
Got it. And so then John and then Michael, do you guys mind going through kind of that first deal, right? That you did, how you found out about it, right? Obviously you guys had partners, how you met them, and kind of what they look like. Not the partners, what the deals look like.
Yeah,
well, Michael, why don't you go ahead and start, since you're the one that found the deal?
Yeah, so I found the deal probably about going on 2 years ago now. I think talking about it in this setting is actually very appropriate. I found the deal by going to a networking event and meeting with some people, and actually met the son of one of our business partners there. And he introduced me to his father, who's now our partner. And this gentleman owned this land, and he's owned it for, I guess, 5 years now, which kind of goes back to what John had mentioned about entitlement risk. He bought the land and went through the entire process of getting the entitlements done, getting utilities and stuff like that approved for the property, working with the city and the county and whatnot. So it got to a point where he had done a lot of the hard work. He had done a lot of the brain damage involved in getting all that achieved. And we were able to come in and kind of get him across that hump. He needed someone to kind of bring some fresh capital to the group, buy out some minority partners that he had. And so at that point, I had reached out to John to kind of help me come in and kind of vet this deal. That kind of comes from, and John, I've known John for, I guess, 4 going on 5 years now too, just from previous networking events and keeping in touch and building relationship over time. So that, once again, being in a situation like we are right here in this meetup, I think is very appropriate, because this is kind of where it kind of starts, and it might happen 4 or 5 years later. You don't know. I mean, when I first met John, I didn't think that this would happen, but we built that relationship over the years. So I reached out to John. Hey, John, come down. I've got this deal. I knew that John had already started pivoting towards development about a year prior to that. And so he had a head start. And so, John, come in and use your big brain and help me vet this and see if this is a good deal or not. So, John, I'll let you take over from there.
Yeah. So we met with the developer and literally 5 months of due diligence, checking the boxes, de-risking the deal. We were able to come up with the right structure and the right terms to take out the exiting partners, to keep the developer in the deal. And at that point where we were in the land was, pretty much close to full plans and entitlements. We had a little bit more engineering work to do and some permitting. And so we basically closed the deal last September, so just over a year ago. And 1 year later, we've already gotten our permits. We're already pushing dirt. We're already doing all of our horizontal development. We can talk about what that means in a little bit, but doing all of our horizontal development and hopefully putting sticks in the air in Q1 of next year. So that'll be a 302 unit A-class multifamily property in Katy, Texas, which is a growing suburb west of Houston, right off of Fry Road. 46,000 cars pass by the site a day. So we love the site. We love the cost basis that we are in the deal at, and we got a great deal, or a great partner with the group, and looking forward to getting this project rolling.
And how did you guys structure that and syndicate it?
Yeah, so it was a combination of a bank loan, as well as friends and family syndication to finish off the capital stack, to basically take down the land and then kind of get us through up to this point, which is full horizontal development completion, where at that point we will convert that land loan into a vertical construction loan. We're not using HUD, as Darin mentioned. We're using probably a bank loan. We're using probably a bank loan. We've got a couple lenders that we're talking to right now, but just based on where we are in the development cycle, it just made more sense for us to move forward with the bank loan versus the longer lead times associated with HUD.
All right.
Yeah, we looked into the HUD, but the HUD at the time that we started on it, we wouldn't really be ready to start going vertical until at the very earliest July, August of next year. And we felt we were ready to kind of go now. And so we didn't want to wait, save that extra 5-6 months. I mean, the terms, as Darin mentioned, the terms on the HUD side are extremely attractive. but there are some minor downsides to it. Primarily, one is just the timeline up front. If you are already targeting a piece of land and you know that you have a good feeling that you're going to go forward with that's the time for you to kind of reach out with HUD already. We were a bit too far in the process and weren't willing to wait.
All right, and so y'all's play really is, rather than do kind of the slow drawn out HUD approach, right? Yours is very much big term, short loan during development. Then you can either kind of exit the asset entirely or do a refi into a berm, right? Something, Fannie, Freddie.
Right.
So.
Right.
That's
Yeah,
right.
but believe me, the 85% loan to cost and the 40-year amortization on the HUD is very, very attractive. We looked at it long and hard and just decided not to go that way. So
I prefer 90% construction to value, and then I prefer full term IOs, but I'll leave it at that.
Non-recourse.
No, yeah, for sure. No, HUD is attractive. So Darin, that's probably a good kind of segue to you, right? The question that I had for you next is really, what are the deals that you're doing today, right? How do you typically structure them? What are your equity groups? Kind of what do they look like, right? Are they friends and family, or are they not, or are they mixed, right? And then the third piece is, and this is where I'm going to yin back to Michael and John, is, what are their expectations of returns, right? Obviously, it's a development play. The land doesn't produce money, right, for a while. So what does that kind of look like to them?
Well, let me share this. So we typically have 3 major players in every deal. We typically have a lead developer, which we will co-develop and do a support role there. We typically have a general contractor who has quite a bit of experience. We wouldn't be using somebody that didn't have big multifamily experience. And then we have the equity side, and that's really the component where we fit in. So we'll typically bring 90%, 100%, 50% of the equity. Rarely do we do less than 50. But what the deals look like is the developers are the sponsor, and we'll co-develop with them. Typically, the GCs are hired, and then we come in as the equity sponsor. And not much different than what we're doing 5 years ago, or what a lot of you guys are doing. But we focus more on multiple and cash flow versus IRR. So when we're structuring our deals, we're really looking at, from the equity side, we've got to make sure our equity is hitting a certain pref. And then we typically have performance splits after that. Now, I will tell you one thing that has changed over the last 7, 8, 9 years. We started making this change a couple of years ago. And I think all investors should be aware of this going into it. And I'm not speaking for everybody here. I'm just talking about us because we're longer term. We used to do in the BC world, when you're flipping out of it, I think you'll see the difference here. But we used to do a pref plus 100% capital. We are now doing a pref, and then we do a split with the sponsor and the equity after that. So we're no longer structuring our deals where all the capital gets paid back, because if we're holding them longer term and we're into that 4th, 5th, 6th, 7th year, it may be a long time before the sponsors get rewarded for their work. Because so we started making that's one of the changes we started doing on the capital stack. The other thing we're seeing quite a bit of.
Just so I understand it, you're only doing a return of capital event on a basically disposition, right? On a sale.
On a disposition, right? Yeah, but I mean, the ones we're holding, we and all of our investors would go, we get it, we understand, we know the model, we know what you're doing, and we want you guys to get compensated for what you're doing. The other thing we're seeing a lot of out there, and I'd like to hear from John and Michael on this, there's a lot of pref equity out there, and pref equity in the capital stack, it's bank debt, pref equity, common equity. We pretty much play in the common equity world. We do pref equity every now and then, but we're seeing a ton of pref equity. And the terms are fairly egregious, but I know people need that money. The other thing that we're seeing a lot of right now is that we're getting more calls today for common equity than I had in the 4 years prior. And I think what's happened because of COVID is that the common equity, so much of that has either sitting on the sideline, or the higher net worth people are not as willing to I guess, pony or come into deals. I think they're still kind of waiting to see what happens. But we're getting really good opportunities with common equity, and we're getting better terms with the developer and the GC than we got 2 or 3 years ago.
And just to clarify that, you're getting more calls for you to place common equity.
Correct. We
right.
are getting.
Therefore, you're able to negotiate better deals in general.
Correct.
Right?
And we're still, and I love John's point. I mean, you got to de-risk these things, and we're getting to be a little bit selective right now, which that hadn't been the case always. I mean, we were hustling 2 or 3 years ago pretty hard to get good terms. We're not so much now. We're not having to hustle as much, and we're getting better terms.
Yeah. And then maybe it's kind of the last point of my question is your equity friends and family, private equity, family office, institutional, everything under the sun? I mean, just so people kind of know.
No, we started out with friends and family, then we got into referrals and high net worth. So we've been, Tom and I, by the way, my business partner is Tom Burns, who maybe most of you have met at some of the networking events, but Tom and I started off in I'll call it the retail space, friends and family. We have migrated to higher net worth and referral. So we have not gone into institutional. We've tested the waters with it a few times, but it's just seemed our model works better with the friends and family, high net worth investors, accredited investors. And Tom being a physician, he has a lot of doctor friends that are looking for somebody they trust to invest into commercial real estate. So that network has worked out. His 30 years in being a physician has helped us out quite a bit.
Got it. Awesome. So kind of maybe transitioning over. So one of you three, who wants to explain the life cycle of a deal, really going from, I have land out in the middle of nowhere. What are the phases that kind of it takes, right? And the reason I said middle of nowhere, because assume there's no utilities, right? What are the people can understand, and then what, and each time you're improving the land, right? You've added value, but just people can understand maybe the life cycle, and then from that, maybe understanding where you guys typically come into that life cycle.
Well, here, I want to say one thing on that. I'm going to turn it over to those guys, but I'll chime in. Here's one of those mistakes that I made that I think John was talking about on the de-risk. In today's world, we will, and I think they have a partner like this on the land. If you can find the right land seller that will stay in the deal until you get all the entitlements done, or until you can get to the construction loan or the closing, that's fantastic. I can't tell you how much pressure that takes off of you in the beginning of looking at a deal. One of the biggest mistakes that I made on that first one that we did, not knowing what I was doing, I got all excited to control the land. So I went in and bought the land. So here I am holding a piece of dirt, and then bam, 2008, 2009 hits, and I'm sitting there going, what do I do? And part of that $1 million we were talking about was money I had on the land already. It was architecture, engineering, land, interest carry. There was a lot on there. So that's, if I can encourage anybody at the beginning of that process, and that's just one of the parts in the beginning, find that right land partner. It will make your life so much easier. So I'll turn it over to you guys.
Yeah, I 100% agree. When I was talking about those 4 risk points, the first one being the riskiest, and that's entitlement risk. A lot of people that wanted to get into new development, buy the land first, like Darin said, and hope that, their master vision of doing 300 multifamily units is something that city council or whoever the developer, whether it's the county or the city, they may not agree with your vision. And so a lot of people will buy the dirt and get their plans turned down, and now, they're stuck. So I completely agree with Darin. If you can partner with either a landowner and or a developer that already has control of the land, that is either, shovel ready, permit ready, or kind of on the path to full entitlement. For us, that's what we like to get into. That's what Michael brought to the table with this deal and Katie. That's really where most of the risk lies in new development. So if you can get past that first risk bucket, the rest of it is relatively less risky. But Michael, I'll let you answer the question on the development cycle.
Michael, they're hot potatoing the question of the life cycle of land, man. You know, they're setting it up for either success or failure here.
Yeah, I mean, as I said, it takes a long time, and you really have to kind of know, I guess, the jurisdiction, you know, and all the related red tape that can be involved. You know, I've spoken. I was at a conference, I guess, a couple of years ago in Santa Monica, talking with a developer there, and he says it takes 2 years for them to get permits, if not more. That's a minimum. And so there's businesses around just that where they get land and they'll work through that 2-3 year period of entitlement and then sell it to the developer, you know, at a multi-million-dollar markup. And the developers would do that because that does take the risk out of the picture. In our particular piece of property, and as I mentioned, you know, our partner had bought that land 5 years ago, and at that time there was no entitlement, there was no utilities. This land was infill in the sense that there are, like, you know, a couple thousand houses all around it already, but you know, the water and sewage plant for those houses were already built to suit. They were built to support exactly what, you know, they already had there. And now you go and you're going to put another 500 people that are going to be taking showers and flushing toilets all day. They didn't have the ability to do that. So they had to go through a whole process where they worked with the local municipal utility district to actually sell bonds so they could raise money and expand the water and sewer plant. And as you can imagine, that's a process. That's a long process that takes in terms of having to put out for vote, you know, from the people that live there, that they're willing to sell the bonds, which, you know, which raises their taxes and whatnot. And then
are you in a mud?
Was that?
We're in a mud.
Yeah, it's a mud. Yeah. So right. So this is, and that's obviously things work differently in other locations in Texas. This is the way it works. We have muds that are like tax. They are entities that can tax for these purposes. But yeah, it's a long process. Unfortunately for us, by the time that we got involved. One of the reasons we did get involved was because that was already approved by the local mud district. And they even had money assigned for us in an agreement that anything that we put in on the property that would be considered public works, that they would reimburse us for the cost of those sewer lines and water lines that we put into the property. So those are all things that factored into why we felt the deal was de-risked, right? It was approved, and not only that, but there was money that would cover a lot of our costs associated with it.
$1 million worth of mud money is coming back to us once we finish up all the public works. But to finish off the question, Feras, so the big buckets are: you buy the land, you get it entitled. Then once you have it entitled, you do all of your horizontal development, or some people call it dirt work. That's where you know, you do all of your grading of the land. That's where you pull in all your utilities, you build your interior roads, and then once all of that is completed, then you get a construction loan where you then go vertical. So you go horizontal development, then vertical development, then all the way up through certificate of occupancy, and then you go into lease up. Once you go to lease up and get through stabilization, then you convert from a construction loan into a permanent loan. Those are the big buckets.
All right. Thank you guys very much. And then maybe also a dumb question for people, but I know people probably want to know this. What does entitlement mean?
It basically just means that the authority, whether that's the city or the county, has approved, you know, basically your plans, which includes all of the vertical as well as the horizontal, as well as the use, and issues, you know, permits for you to be able to start, you know, doing your development.
Yeah, and let me add to that. I mean, there's pseudo entities out there too that you have to worry about, because there's a lot of you know, NIMBYism in America, not in my backyard. So in our case, we talked with a lot of civic groups. We talked with the local, we're abutting right next to an elementary school. So we talked to KDISD. We talked to churches. We talked to HOAs. We talked to the mud board. So there's a lot of groups that don't have direct influence, but they have indirect influence. If you have someone loud enough and scares enough of the politicians involved, then that might give you trouble too. So those are all things that can factor into this entitlement piece.
Right. And so then maybe kind of continuing on. So if anyone has any questions, go ahead and dump them. I have a million more, but I want to make sure let people ask questions. So we'll maybe do another like 7 minutes of, let's just say fire round of questions, right? We'll see how many we get. And so I'm just going to ask the questions. Either of you three more than welcome to hop on and answer it, or if not, I can pick someone. And so with that said, let's see. So first question, and if you guys have a crystal ball, go ahead and get it ready. But do you have any idea when building materials will come back to normal prices?
I'll take that one because we're going through it right now. So we have a project down in San Antonio that we were just about to lock in on lumber. Okay, let's use lumber because I think everybody's in the development space is aware of that. On a $3.5 million lumber contract that we were expecting, it went up $1.8 million. So it is slowed down our process, and that's a little painful right now. So that $1.8 million is now in the last 4 weeks come down to $1.4 million, and we expect it over the course of the next 4 to 6 weeks come down even more. But it stopped our project because throwing $1.8 million of additional hard costs onto the project just said numbers don't work. Can't take that additional risk right now. Now we didn't have any land pressure, from the backside because we already own the land with our development partner. So we have a little bit of time, but it is a little painful waiting for these prices to come back down, but they are coming back down on that lumber side.
Yeah. Different scale. I was at Home Depot yesterday buying some 2x4s, and I was surprised how expensive they had gotten. I had noticed that myself too. Yeah. So,
went from $5 to $9, right?
No, I mean, I remember them being like, like less than $4, and they were like 5.5 a piece. And I'm like, okay, man, anyway. Yeah. So now I feel Darin's pain, just not as much pain as he does.
Yeah, I think our estimate was like from something like 2 million up to 4 million. But by the time that we're ready to go vertical, we do expect it to be back to normal. So
yeah.
All right. So continuing on, I'd like to develop in my small community. We have a housing shortage, but we don't have a good pool of rental comps. Any suggestions? Also, in general, how do you figure out if a market is close to being oversupplied?
We always start with a market study, just to make sure that we've got the demand and the supply balanced to our favor. So we'll spend the $4,000 to $5,000, 2 to 3 weeks of wait time for us to get a good market study, and that'll allow us to make a better decision. And for the most part, most lenders and preferred equity will require that market study as well.
All right. And I know we got a lot of questions, so I'm going to start to blow through these. So next question, what criteria do you have for your GC?
For the general contractor?
Yeah.
Did you say?
Yeah.
For us, we want to know, because of the size of our projects and whether we're doing conventional or HUD. HUD requires that the contractor can bond, ensuring that they can complete the job and that they have a maximum amount of the contract. So that's big for us because we're getting into $30 million, construction contracts on that. So those are the two things we really look for. If it was smaller, bonding may not be as important, but that's just for us. That's one thing that we look at.
All right. Continue on. Where are you building, state and city? So I'm just going to answer this one really quick. Combination of Houston, Austin, San Antonio, Dallas, where I think kind of all speakers are only doing in Texas. Any of you guys doing anything outside of Texas?
Just Texas.
All right. So let's see. So I'm building in Manchester, New Hampshire. I have 11 acres under contract in Hudson, New Hampshire, working on a variance for that piece. Okay, Alex, sorry, that wasn't a question. How long did the permitting process take, and did the county have limitations on what you could build?
Say it again first.
How long did the permitting process usually take? And are there limitations from the county? That's maybe the question.
I'll tell you what we do. And these guys have actually gone through the process more than we typically would. We find the developers that have, or the landowners that have already gone through that process of entitlement. And that process can take years. I mean, it can take a year, it can take 2 or 3. So from the beginning, if you're starting on your own, I would be very cautious about expecting it to happen in a few months or more. If you're taking a raw piece of land and you're taking it all the way through the entitlement process, depending on which city, which county, what neighborhood associations have to say, what demand is, all kind of things, it could take up to a couple of years.
Yeah, I mean, in our case, our properties out of the city limits is in the county. The county has less restrictions in that regards, even though we try to kind of stick to the guidelines of the city for the off chance at some point the city might annex for a piece of land. Houston is known to do that. But yeah, I mean, the process could be involved multiple things. I mean, we had to work with the, being in Houston, we had to work with the Harris County Flood Control District to make sure that the land met all of the requirements that came about from FEMA after Hurricane Harvey happened. So a lot of the flood zones were redrawn. A lot of the requirements of getting, your land outside the 100-year floodplain and your actual pad sites, you have to build a few feet above the 500-year floodplain. So all of those things we had to get with our civil engineer, who had to bring in their special hydrologists, who then would work with the counties, the flood control districts, engineers to kind of get everybody to agree on it. How much, we had to build a 2.5-acre detention pond that required us to get 5,000 truckloads of dirt out there. And these are all numbers that both our civil engineer has to agree with on their side. And it's not black and white. There was a lot of, give and take. They wanted to take whole swaths of land for right of ways that would have cut right down in the middle of some of our buildings. And so we had to push back on that. They agreed. So it's not like they just come in there and making unilateral decisions. There's a lot of back and forth in that regards. And that goes to having the right partner. We had, our civil engineer who used to work in the flood control district and was very familiar with that. And knew a lot of the people on that side of it. So there's some politics, that comes into play in that sense too, of just trust and understanding how to work the system.
All righty. So let's keep going then. So here's a question that I think that, Darin, this is for you. This is an interesting question. But since you kind of do more on just the equity piece, what are the typical negotiation deal points you negotiate in the developer/GC contracts?
Oh, for the developer?
And the GC, so I guess it's
and the GC contract. Well, so one thing that we have a GMAX, and that's guaranteed maximum contract. So we know that the general contractor is not going to spend more than that, and if they do, they're responsible for it contractually. Okay, and there's things that I think people should always consider. There's a thing called retainage. Okay, holding money back until the actual architect, the lender, has all verified that the work has been, the materials were bought and the materials were put on site and they were applied correctly. There's little checks and balances like that. On the developer side, if the developer fee, to just say, is $1 million on one of our projects, there's part of it that comes up at closing of the contract. And then at certain percentages of construction completion, you have these stages where you pay them. So you may have 4 or 5 where you got a big piece of it at the end when you actually go through like a certificate of occupation, when you do the CO, something like that. So, we put all these little milestones in all the contracts to ensure performance. And there's all different ways to structure them on there. Now, we also will look at a development team. And when I mentioned we may co-develop, the development team may not be as robust as we think they should be. And we will actually interject ourselves into the development team contract with one of our people for roles and responsibilities. And it may be something as simple as, we have one as simple as monthly reporting, and that costs us to do that. And we have another one that is reporting, and we do all the accounting. This team, we didn't think had a strong enough accounting team, and we wanted to make sure, since we were bringing all the equity, that we were accounting for all the numbers on a weekly basis. So there's a lot of little things you can put in there, but those are a few of them.
Interesting. All right. I know we're running short on time, so we're only do a few more questions. So I'm going to skip over some questions that I think we've either answered or kind of don't apply. But here's probably a good one. How do you find a land partner other than just going to networking events and hoping one attends? And what % of the returns for the deal should you expect to give the land partner? Right. So really, it's how do you find a land partner and how do you structure them into the deal? Not all at once.
Okay. We're doing one right now. Okay. I'll give a quick example.
Maybe yeah, 2 people can answer this one. So, all right, Darin, go.
I'll make it quick because I want these guys to share about theirs. I'm curious as to theirs. So we have a gentleman that is putting in the land. The land is valued at $3.4 million. He brought it all the way to entitlement. He's now handing it off to us. He's bringing his $3.4 million is an LP position, and it's going to sit in the deal, and it's going to earn the same amount of money that all the rest of the new money coming in the deal will earn. He wanted long-term cash flow. He's in his 60s. He's going, man, I want to set it and forget it. He knows the area really well. So he did entitlement, contributing the land. That'll act as part of the LP contribution. He'll get the same returns as everybody else.
And third-party appraisal?
Yes. Yeah. And he probably bought it for half that, but he did all the entitlement work.
Yeah, so you guys got a third-party appraisal after he got entitled to argue.
Yeah.
Is that usually just straight up, it's what the number says, or is there a little bit of negotiation? Because I was actually wondering that.
There's a little bit of negotiation. Yeah, but I mean, you got to keep it pretty real.
Got it. So, okay, third-party, appraisal says it's worth 3.5. Look, we'll give you we'll bring you in at 3.7 and call it a day, right? Kind of.
Yeah, I mean, because the amount of time, that extra 100 or 200 grand for us, and not having to do all that work for 2 years, worth every penny of it.
Awesome. All right. And John, you wanted to kind of answer that too?
Yeah, I would say it's the same structure. So again, the developer or the landowner, we always want to keep them in the deal so that they have skin in the game. And again, depending upon their experience, they either come across as co-partners, co-GPs, or in a limited partner capacity. And same thing, their contribution is typically the value-added land as part of their ownership. And in terms of finding deals, Michael said it earlier, you just never know what conversation, what meeting, what networking event is going to lead to a deal. You just kind of put yourself out there. And
that's
I'm
how
in Texas.
Real estate works regardless of what you're doing. Right?
I'm in Texas. I don't do deals outside of Texas. If you got a deal, let's have a conversation.
That's why John's really here, right? So I thought John was here because he wanted to talk to me, Pal, and Garrison, but I think he's here looking for developers and land owners. So yeah, awesome, guys. Well, I think, I want to be respectful of everyone's time, so we'll go ahead and call it a wrap there. For those of you that asked questions I didn't answer, I apologize. We probably, I could have gone on for a little bit longer, but, thank you guys very much. Really appreciate it. I mean, great information. I learned a lot. Usually I don't learn as much, and this one I think I've probably learned more than any of the other panels. So Darin, Michael, John, thank you guys very much. You guys are welcome to stick around. Can you guys go ahead and leave your contact information Michael's on his A game. Go ahead and leave your contact information in the chat, in case anyone wants to reach out to you guys. I mean, I'm sure people might be interested in, you guys are welcome to stick around. We will do breakouts now where we'll break out the audience into, groups of about, I don't know, Pal, what do you think? Let's do 8 people. So let's do 6 people. So groups are about 6-7 people. And from that, people can kind of network, get to know each other. Maybe you run into one of these guys. Maybe one of you guys are a land developer and you run into these guys. You never know, right? And if a deal does happen, MFM, basically would like to take about 10% of the net profits after you guys have done. No, I'm kidding. But, we hope you guys meet someone interesting, someone exciting. So definitely
I didn't know the M, it was standard for multi-level marketing.
Actually, right.
Awesome. Thank you guys so much. Real quick, we're about to enter breakout rooms. We are Multifamily Masters Live. If you're interested in learning, sharing, networking, growing this business, reach out to Feras, Pal, myself, Bethany Smith, anyone on our team. Check out our website, multifamilymasters.com for information on our mastermind. We do this every 2 weeks. If you're interested in becoming a local expert, if you're interested in hosting your own meetup, reach out to us. We would love to help you. We have a turnkey system for meetups. We have 70 or so meetups across the globe. We definitely want to have one in your town, in your city. I just hit the breakout rooms. We'll be doing that in about 50 seconds or so. If you missed any of this recording, wealth of information, feel free to check us out on our YouTube channel, multifamilymasters.com. Check out our Facebook group, multifamilymasters.com.
Hey, Garrison,
Go
real
ahead.
quick, how long are we going to be in the breakout rooms for so that people know?
5-8 minutes. We're running a little bit late, and then I'm going to let the
Okay.
channel open, and you guys can network together afterwards. 1, 2, 3 hours, 5 minutes, however long you want. This is all about networking. We are a meetup organization that knows everything and anything about multifamily real estate.
Awesome.